By the end of this video, you should be aware of some of the risks, hazards, and pitfalls to securing retirement income and ways that you can secure a lifetime of guaranteed tax-favorable income amidst changing market conditions. Hi, I'm Gordon Weeb. I'm registered as an underwriter in the provinces of BC, Alberta, and Saskatchewan. My practice focuses on helping clients meet their financial goals and objectives, typically through the use of annuities. Just before we begin, regulations require the following safe harbor. This presentation is produced and published on and around August 18, 2020. It is for illustration purposes only, and it is not an offer to purchase securities or products. Items presented here may not be suitable for everyone, values will fluctuate, and rates will change. Please consult an experienced qualified licensed professional prior to investing to ensure that your investments are part of a comprehensive plan designed to help you and your family meet your long-term financial goals and objectives. When recommending products, broad tax and legal issues may be discussed. Nothing should be construed as tax or legal advice. There. Now that we've navigated the compliance waters, let's sail on. Here's our agenda. Number 1, we're going to discuss some Mount Everest trivia. Number 2, we'll discuss what Everest expeditions can teach us about attaining goals and objectives. Number 3, we'll examine some of the megatrends surrounding retirement planning. Number 4, we'll review some of the risks and challenges involved. And number 5, draft a plan and explore some ways of mitigating risks and helping you meet your retirement goals. Let's start with a quiz. Can you name the first individuals to summit Mount Everest? Here's a picture of the individuals. Here's the newspaper headline. And here's how the news came across the wire on June 1st, 1953. And of course, the answer is Tenzing Norgay and Edmund Hillary. Now, there's a bit of mystery surrounding who gets credit for being the first to climb Mount Everest. In 1924, there was a British expedition led by renowned climbers George Mallory and Andrew Irvine. Mallory was last seen about 800 feet below the summit when a weather system closed in. Observers in base camp could no longer see him, so no one really knows whether he made it to the top or not. It's a mystery to this day. What is clear is that neither Mallory nor Irvine returned to base camp that day. I think there's a bit of an object lesson here, and it's a theme that surfaces in the Everest movie produced by Universal Studios in 2015. When planning the mission, the objective has to include the round-trip component. With Everest, it's not enough to summit. The mission doesn't end there. You have to ensure that you and your team return safely to base camp. That theme was so brilliantly captured in the book Into Thin Air by Jon Krakauer, the book upon which the movie is based. Strangely, history repeated itself in the spring of 2019 when disaster struck upon Mount Everest again. But more about that in just a moment. When President Kennedy announced that the U.S. would go to the moon, he ensured the mission statement included the round-trip component. The mission was not complete until the astronauts and the capsule had safely returned to Earth. I think it's an object lesson worth noting when it comes time to planning your retirement. The objective hasn't been to save for retirement. The mission or the objective has been to save for retirement, create a lifetime of reliable, sustainable income, and then distribute your residual assets to your loved ones or desired beneficiaries. Any mission or objective statement that fails to include the lifetime retirement component or the orderly distribution of assets is lacking. And it's going to be critical because metaphorically, we're now summiting. Some 75 years ago, the first newborns of the baby boomer generation started to arrive. This generation would go on to become the most active, the most educated, and the wealthiest generation in history. They've had a huge impact on all aspects of the economy in the US and in Canada. They're currently in their peak earning years and have now started retiring en masse. For the rest of the decade, 10,000 baby boomers are turning 65 every day in the United States, and 1,000 baby boomers are turning 65 every day in Canada. You'll likely have experienced the impact this generation has had on the value of all assets. They've elevated the price of real estate. They've helped to elevate the price of stocks in the United States. And they've pushed up the price of Canadian stocks as well. Most Canadians have gone about saving for their retirement goals by investing in mutual funds. So at the end of June, over $1.6 trillion were invested indirectly in stocks and bonds. The chart shows that Canadians have largely been taking their advisors' advice and diversifying across asset classes when allocating capital. $1.6 trillion is a staggering sum, but valuations have been elevated by some favorable market conditions. Let's examine some of the factors that have given rise to that trend. For the past 40 years, interest rates have steadily declined in the United States to the point where the yield on the 10-year U.S. Treasury bill was 0.709% on August 14, 2020. And in Canada, the chart shows similar trends with the yields on the 10-year Government of Canada marketable bonds, which on August 14, 2020, yielded a meager 0.61% per year on capital. At those rates, an investor would need to invest about $8.2 million in order to draw an income of about $50,000 annually. How did interest rates get so low? Traditionally, central banks like the U.S. Federal Reserve or the Bank of Canada have lowered interest rates whenever they've feared a recession or an economic slowdown. Lowering rates has the effect of making credit more affordable, and it stimulates economic activity. Then, as the saying goes, the bankers are supposed to slowly remove the punch bowl as the party gets rolling again. But ever since the dot-com bubble 20 years ago, central banks and the politicians who appoint them have been reluctant to raise interest rates. It's like trying to avoid a hangover by staying drunk. The only problem is, the severity of the inevitable hangover is often determined by the binge that preceded it. Or, as Warren Buffett says, you have to understand one thing about the Federal Reserve. It's not as powerful as the mystique would make it. Its brake is better than its gas pedal. And when the Fed wants to put on the brakes, we all go through the windshield. That ought to serve as a warning to investors everywhere. Here are some items planners and retirees need to know if planning for a lifetime of income. First, low interest rates lift the price of all assets, stocks, bonds, real estate, farmland, etc. Higher interest rates causes those prices to fall typically. Second, low interest rates have encouraged record amounts of debt amongst students, car buyers, consumers, home buyers, corporations, and governments at all levels, local, provincial, and federal, especially now during the COVID crisis. Third, we'll likely see signs of inflation as national security concerns are ramped up and supply lines are drawn for domestic sources. Fourth, we'll likely see broad-range tax increases as governments struggle to provide programs during the pandemic. Now, I hate to be political, but the nation is suffering from a lack of leadership and vision at all levels from all parties. But most disconcerting is the lack of leadership from the Prime Minister's office. Even before the pandemic hit, Canada's federal government was setting record deficits. And since the pandemic hit, they haven't even tabled a budget, and now the finance minister has resigned. There's no accountability, and there's no way of knowing what Canada's fiscal house currently looks like. Now there's one more risk factor that is often overlooked, and it has everything to do with the baby boom generation that we discussed. Question: what happens when all of those baby boomers start withdrawing their funds in order to support their retirement income? Or put another way, what happens if there's more climbers than there are ropes and oxygen tanks available? Here's an eyewitness account of what happened during the spring of 2019 on the peak of Mount Everest. A doctor from Arizona had dreamed his whole life of reaching the top of the mountain, but when he summited, he was shocked by what he saw. Climbers were pushing and shoving to take selfies. The flat part of the summit, which is about the size of 2 ping pong tables, was packed with about 15 or 20 people. To get there, you had to wait hours in line, chest to chest, one puffy jacket after the next, on an icy, rocky ridge with a several thousand-foot drop. He even had to step around the body of a woman who had just died. Now, no one knows what will happen in the markets over the next decade, but I think there is an immutable law of retirement. and that's namely this: retirement income is better than retirement savings. Here are some strategies and solutions that can be employed to ensure that your retirement savings don't fall off a cliff. Number 1, stay liquid. Ensure a good portion of your assets are invested in vehicles that have no downside risk, like a daily savings interest account with an insurance company. Number 2, pay down any outstanding debt, especially non-deductible, high-interest rate debt. If rates start to rise, you will have limited your potential liabilities. Number 3, consider converting your mortgage to a Manulife One or an equivalent home equity line of credit. Number 4, purchase an annuity. If you're requiring income, an annuity guarantees tax-favored income for the rest of your life on non-registered accounts. If you draw income from a RIF or a registered retirement income fund, converting it into an annuity will ensure you never take a pay cut because of a rise in interest rates or a decline in the markets. Rates are highly competitive. If purchased from a non-registered source, your payments will be highly tax efficient. You will never take a pay cut, you will never stop receiving income, and should you not survive a specified guarantee period, you can designate a beneficiary to receive your income in your place. A couple more items. Strategy number 4. Over the long term, you will still need exposure to growth vehicles like stocks or equities. Consider holding them in segregated funds. They're like mutual funds and ETFs, except they have some added retirement smart features, including A, capital guarantees, B, the right to name survivors as beneficiaries and bypass the probate process, C, a higher degree of creditor protection should creditors apply to seize some of your assets. Number 6, now is not the time to leverage investments. When the markets are setting all-time highs, borrowing money takes on a whole new level of risk. Instead, consider securing sources of financing for the future if and when favorable opportunities emerge. In summary, those climbing Mount Everest have much to teach us about establishing retirement goals and objectives, like recognizing, for instance, that a measured descent is a critical part of the mission and the objective. Number 2, a crowded peak is hazardous to everyone. And number 3, as with mountain climbing, risks and hazards are always present, even though some are hard to discern. And number 4, with a bit of foresight and planning, most of the risks can be managed or at least mitigated. And that's it. If you have questions or would like further information about how you can guarantee lifetime income and reduce the risk to your retirement portfolio, please contact me, Gordon Wiebe, by email at gord@think-income.com or visit my website, www.think-income.com. Thanks for watching. Remember to stay safe, stay well, and stay sage.